It'll why cash flow beats capital gains. Over time, optimize subtitle. The overlooked reason long-term investors sleep better during market crashes, full long script, 10-12 minutes. In the vast, intricate world of investing, a landscape filled with flashing numbers and endless streams of data, it's easy to get lost. Every day, the market tells 1,000 different stories. Stories of soaring triumphs and devastating losses, of fortunes made in an instant and wiped out just as quickly. For the average person looking to build wealth, this constant noise can be overwhelming, even paralyzing. It creates a powerful illusion, a siren song that lures millions of investors toward a single, tantalizing focal point. Most investors focus on one thing: price. It's the number they see on the news, the figure that dominates headlines, the metric that seems to define success or failure. They become fixated on the daily, hourly, even minute-by-minute fluctuations of a stock's price. Their strategy, whether they realize it or not, becomes a simple one: buy low and hope to sell higher. They are caught in a speculative dance, constantly trying to predict the unpredictable whims of the market. This price-centric approach is fueled by emotion. The thrill of seeing a stock price jump creates a rush of excitement, a feeling of being smart, of having outwitted the market. Conversely, the fear that grips them when a price plummets can lead to panicked decisions, often resulting in selling at the worst possible moment. They are riding a roller coaster, their financial well-being tied to the volatile sentiment of the crowd. This path is exhausting, stressful, and for many, ultimately unsustainable. It's a game of chasing fleeting gains, a game where the odds are often stacked against you. But the investors who stay wealthy, the ones who build lasting generational fortunes, play a different game entirely. They understand that the ticker tape tells only a fraction of the story. They look beyond the noise and the daily drama. They focus on something far more fundamental, more powerful, and infinitely more predictable. They focus on cash flow. Think of it this way: a price-focused investor buys a tree hoping to sell the entire tree for more money later. Their success is entirely dependent on finding another buyer willing to pay a higher price. A cash flow-focused investor, however, buys the tree for the fruit it produces, year after year. They aren't primarily concerned with the resale value of the tree on any given day. They are focused on the consistent, reliable harvest it provides. This is the core of the cash flow philosophy. It's about owning assets that generate income for you. For stocks, this means dividends, a share of the company's profits paid out to you, the owner. For real estate, it's the rental income you collect each month. For bonds, it's the regular interest payments. It's not about speculation, it's about ownership. It's the difference between being a gambler at the casino, betting on the next turn of the card, and being the owner of the casino who profits from the consistent operation of the business itself. And that fundamental difference in perspective explains why some portfolios grow steadily, weathering storms and compounding wealth over time, while others, built on the fragile foundation of price speculation, collapse under the slightest pressure. The cash flow investor builds a financial fortress, reinforced by the steady stream of income from their assets. The price-focused investor, on the other hand, builds a house of cards, vulnerable to the first gust of wind from a market downturn. Understanding this distinction is the first and most crucial step toward transforming yourself from a mere market participant into a true, long-term investor. It's the secret that separates fleeting luck from sustainable wealth. To truly understand how to build lasting wealth, we first need to grasp the fundamental mechanics of how investments actually generate returns. In the vast world of finance, there are essentially two primary paths to profit: capital appreciation and cash flow. While both can lead to financial growth, they operate on vastly different principles and offer profoundly different experiences for the investor. One path is a winding, often unpredictable road, heavily influenced by the whims of the market. The other is a steadier, more reliable stream. Understanding this distinction is the first crucial step toward building a financial foundation that isn't just profitable, but also resilient and secure, providing peace of mind regardless of the daily headlines. Let's first look at capital appreciation, also known as price gains. This is the concept most people are familiar with. You buy an asset, like a stock, a piece of real estate, or even a cryptocurrency, with the hope that its market value will increase over time. Your profit is realized only when you sell it to someone else for a higher price than you originally paid. This model is fundamentally based on speculation about future demand. Price gains depend entirely on someone else paying more for your asset later. Think of it like a game of musical chairs. As long as the music is playing and more people want to join the game, the value of the chairs goes up. But when the music stops, someone is left without a seat. This reliance on market sentiment makes capital appreciation inherently volatile. It's tied to economic news, investor psychology, and trends that can shift in an instant. The potential for rapid, significant gains is certainly alluring, but it comes with an equal potential for rapid, significant losses. It requires a strong stomach for risk, and often, a bit of luck in timing the market perfectly, which even seasoned professionals find nearly impossible to do consistently. Now, let's turn our attention to the other path: cash flow. Cash flow does not depend on selling the asset. Instead, it's the regular, predictable income an asset generates simply by you owning it. It's the rent check that arrives from a tenant each month. It's the dividend a stable, profitable company pays out to its shareholders every quarter. It's the interest payment you receive from a government or corporate bond. Unlike capital appreciation, which is a one-time event upon selling, cash flow is a continuous stream of income. It's the fruit the tree produces, not the hopeful future sale of the tree itself. This is the critical difference. Cash flow arrives whether markets rise or fall. Imagine a global economic downturn. The stock market might be in a free fall, and the paper value of your portfolio could decrease significantly. If your strategy was based solely on price gains, this would be a moment of pure panic. But if your portfolio is built around assets that generate cash flow, the story is different. Your tenants are still paying rent because they need a place to live. The established companies you've invested in are still selling their essential products and services, and thus are still able to pay their dividends. This income stream is independent of the asset's daily market price. It creates certainty in an uncertain system. While others are anxiously watching the market tickers, you are receiving tangible, spendable cash in your bank account. This predictability transforms your financial life. It reduces stress and allows for long-term planning with confidence. You're no longer just a speculator hoping for a higher price tomorrow. You are an owner reaping the productive rewards of your assets today. So, to recap this crucial context, investing for price gains means you're betting on market sentiment and need to sell to profit, which is inherently uncertain. Investing for cash flow, on the other hand, means you're focused on the productive output of an asset, generating a regular income stream that provides stability and predictability no matter what the wider market is doing. This fundamental shift in perspective from speculation to ownership is the bedrock of the strategy we are about to explore. Scene 3. Core idea, 130 to 430. Dividends represent income generated by real businesses. They reward ownership, not speculation. When income is reinvested, growth becomes automatic. No timing, no prediction. Scene 4. Retention spike. Here's what most investors miss. When the market tumbles and red arrows dominate the screen, the overwhelming human instinct is to panic. It's a visceral reaction, driven by the fear of loss. We see the value of our portfolio shrinking, and the immediate impulse is to sell, to cut our losses, and run for the safety of cash. This emotional response is completely understandable, but it's also where the average investor's strategy diverges sharply from that of the world's most successful, long-term wealth builders. While most see a crisis, the seasoned investor sees a clearance sale. They understand a fundamental, yet often overlooked truth of investing. During crashes, prices fall, but income often continues. This is the critical distinction. The of a stock is what someone is willing to pay for it at any given moment. It's driven by market sentiment, news headlines, fear, and greed. It is, by its very nature, volatile. But the dividends a company pays to its shareholders is something entirely different. It's not tied to market sentiment. It's tied to the company's real-world business performance. It comes from actual profits and cash flow generated by selling products and services. Think about it this way. A global consumer goods company doesn't suddenly stop selling soap and toothpaste just because the stock market is having a bad week. A utility company continues to provide electricity and collect payments. A major telecommunications firm still has millions of customers paying their monthly phone bills. These are robust, profitable businesses. While their stock prices might get temporarily dragged down by a wave of market-wide panic, their underlying ability to generate cash often remains remarkably stable. For strong, well-established companies, cutting a dividend is a last resort, a signal of deep, fundamental trouble, not something done because of short-term market volatility. That income allows patient investors to buy more ownership at lower prices. This is the engine of accelerated wealth creation, a concept known as dividend reinvestment, or DRIP. When you receive a dividend payment, you have a choice. You can take it as cash, or you can automatically reinvest it to buy more shares of the same company. During a market downturn, this process becomes supercharged. Let's imagine you own 100 shares of a company, and it pays you a $100 dividend. If the stock price is $50, your $100 dividend buys you 2 new shares. But if the market crashes and the stock price falls to $25, that same $100 dividend now buys you 4 new shares. You receive the exact same income, but you acquire double the assets. You are systematically accumulating more ownership of the company, not because you invested more of your own money, but simply because you allowed your existing investment's income to work for you at a more opportune time. You are turning the market sphere to your direct advantage, using the same amount of dividend cash to acquire a larger piece of the pie. This is the power of compounding working in overdrive. Each new share you acquire at these lower prices is another little engine that will generate its own dividends in the future. When the market eventually recovers, and history shows it always has, you won't just own the original shares you started with. You'll own all the additional shares you accumulated at bargain prices during the downturn. Your ownership base has expanded. Consequently, your total dividend income grows, and your potential for capital appreciation is significantly amplified. This is how generational wealth is built, not by timing the market, but by time the market, patiently allowing the dual forces of income and compounding to work their magic, especially when others are guided by fear. Scene 5. Institutional Logic, 6:30–9:30. This is why institutions prioritize income. They don't rely on exits, they rely on operations. Cash flow creates resilience. Scene 6. Close, 9:30–12. Price excites people. Cash flow sustains them. That's why income-focused strategies quietly outperform over time.